Almost 1 year ago to the day, our next guest announced that he was pulling all of his clients out of the market. Today, he says he's putting them back in. Charles Nenner, founder and president of the Charles Nenner Research Center, joins us now. Charles, it is a pleasure to have you with us here on Squawk on the Street. What are you seeing right now that indicates to you that now is time to get back in?
Well, as you know, is that we have mathematical models that show cycles. I don't know if we can show it later. And the cycles show the top the end of December last year. And it shows a low in the beginning of January. And we have also levels that we calculate. And the level is getting close. We could go another 100 S&P points lower. And we expect that the beginning and the middle of January is the low. So we're preparing our clients, because some clients are big hedge funds, and they have to sit and have committees to decide if we can go back in. So we already sent out that in a couple of weeks we intend to go long again. Wow.
Certainly another pressure on hedge funds right now is redemptions. And there has been a report by Sanford Bernstein that there's going to be $200 billion more in redemptions to come. How does that factor in when you're giving advice and most of your clients are hedge funds and you're saying get back in the market and they're forced to sell at this time because they need to cover those redemptions? I'm just curious what you're hearing from them.
The idea is that the markets don't happen at random. So whatever happens in politics, in war and peace, or in redemption has nothing to do with it. That's already in the model.
I see. Okay.
All right. Sorry. Okay, go ahead. You have one more.
No, go ahead.
Okay. All right. And I just walked upstairs. I'm sorry to take a quick break there. My question for you, though, is one of the big headlines we keep hearing, and you trade both the specific in terms of the indices, but also some macro issues, is this whole issue of deflation.
Right.
Whether that's a bigger worry right now, or inflation because of the huge flood of money.
I mentioned that when they asked me at the Squawk box why am I going out, I said, well, deflation, not inflation is the problem. And I think we have a big deflation problem. I think unless we see differently, we're going to have the scenario of Japan of the last 20 years. Because what we see is we see long-term rates going very low. They might go to 1%. We see a strong currency. And in a crisis in Japan, the strong yen was hindering the economic upturn. So we have the same thing. And we see a deflation. And we see a bad stock market. So I think people should much more watch what happened in Japan and think that unless we see something different, that's the scenario we're going to have, and it's going to take a long time.
All right, so let me just play with you for 1 second there, because there are several things, but one big thing everyone points to say why this situation is different than Japan is the banks. Say, well, look, we're admitting we have a big problem with our banks, and we are forcing them to clean this you-know-what off their balance sheets. Or maybe we're not really forcing them to do it, but hypothetically, that's what we're trying to do.
Right.
Does that make you feel any better, feel like we could avoid the fate of Japan, or no?
No, because one of the problems in Japan is it took them a long time to do something. And one of the problems we have here is we have to wait for Obama to come to power. So we're also stuck for a moment. And then you see the politicians, takes them a long time to make decisions. So in theory, it's easy to say we're faster than Japan, but in practical life, I see it also takes a long time to react.